Thanks for joining us once again. This is Greg for Tesla Fan Insight. Today is obviously an interesting show given the trading environment for the week. I want to thank you all for dropping me a note regarding thanks for the 200 prediction by February 1st. We're well on our way. Just a brief stop to encourage you to join us on Patreon as well as subscribe. We want to thank our Patreon subscribers because your support makes all the difference. So today's show is what I want to call schizophrenic, because there are all these conflicting data points that are sort of battling each other, and the question is, how will it all play out? So an example of what I mean is that I opened up with a Goldman Sachs gives a 40% upgrade to Tesla to $200 a share. Now, this was actually really good news. Goldman Sachs is a very big firm. They have a big reputation, and they influence the behavior of a lot of clients. Now, this was also a very strange thing to happen, and here's why. Typically, as you've noticed with Tesla, Elon will announce something big, then we'll have a few days delay, then the stock price will start to move, and then you see the analyst reports confirming that Tesla is in a good position and that it's a good investment. Now, that sequence is logical because what's kind of going on there is that it gives all the people who pay for that research an opportunity to trade on it before the general public sees it, and they can trade on that. And in the case of Goldman and a couple of other firms, they decided to, in essence, front run their clients with that information before most of those clients have had an opportunity to sort of dive into the stock. So I just found that sequence was very strange, but nonetheless, it was one of the impacting variables on why the stock price was up dramatically on Friday. So the other reason why I believe the stock price was up dramatically is that we just saw the first in what hopefully will be several short squeezes that went on Tesla. As you know, a large number of hedge funds have been making a killing shorting Tesla stock. And the challenge was that when you see a stock price accelerate that quickly, particularly Tesla's, there's typically a pullback, and the pullback is associated with the fact that the hedge funds trying to get out will capitulate, buy the stock that they need to purchase in order to close out their positions. And once they're done getting beat up, the stock price kind of pulls back afterwards because you don't have the catalyst of them trying to accumulate shares to exit their positions. We somewhat saw this yesterday in that the stock clearly went almost to 180, then it pulled back to about 175, maybe just a little bit lower, and then it started moving north again. So do I expect another short squeeze? I think that, there's probably a 30% shorts in terms of who's out there. 30% were wise to get out early because the stock will keep moving. There's another 60% to go, maybe 30% are half out, half in, and then there's the hardcore group who's probably saying, hey, this rally by Tesla is ridiculous, and therefore we're going to stay in and get crushed as it moves higher. So I don't think we're done with short squeezes, but we need to see more of the stock starting to run away north for the next round of short squeeze to occur. So the numbers, so now you see what I mean by schizophrenic, because things should work in a certain cycle, and Tesla's really off cycle right now of how it normally does things. One other data point is that there's actually, I've seen one or two downgrades of Tesla based on declining margins in the process that Elon is doing of of cutting prices to spur demand. Now, there's a number out there that's strange that I don't know the precise number, but I can give you sort of the background of the number. So basically, right now, we're looking at a 25-ish% margin for Tesla for, I guess it's the fourth quarter of the year, perhaps it's the entire year. Well, what's weird about that is that Tesla didn't cut the price until, first 2 weeks of January of 2023. And so I just find it weird that everybody is discussing the 25% margin of last year when we're now in 2023. And with the price cut, the real margin number, I think, is going to perhaps coming lower than that because of the price cut. So if everyone's basing their decision making on a 25% margin being lower than what it was previously, what are they going to do when it comes to this year and the margin being 22% or 20%, let's say? Who knows what that actual number is going to be? We're going to find out in about 5 weeks. But it will definitely influence the conversation, especially if we don't see dramatic uptick in sales and revenue for Tesla driven by that price cut, which we've already seen. So I think we're in good shape to see that part. It's just how are the analysts going to react to that lower margin in general. So I just think that I see schizophrenia because we're looking at legitimate data points from different angles of the same object with different groups deciding, one way or the other. So for me, what I think is going to happen, and one of the reasons I went for the $200 price target for the stock for next week, is that there are different large groups of investors and their strategies are very different. So what I see occurring right now is there's a core logic of Peter Lynch's book and every other book. There's a type of investor called a value investor. And so value investors tend to like to purchase the stock price below the growth rate. So the way you come up with a stock price is take the amount of earnings. So the expected for Tesla for the year was I think it's 405 or 410. And you multiply that by the growth rate and that equals the stock price. So in theory, we're looking at Tesla theoretically growing at 50% or just below. I think 37% is the number that comes out from Elon's 1.8 million target number. So let's say for giggles, Tesla's target was 50% for the year. That's 2 million vehicles in the production run. Multiply that by earnings, $4. It's really $4.20 or something, but this is a sketch. So 50% growth times $4 equals $200 a share. So that analysis, that number is like Swiss cheese because there's 50 different ways you could argue, well, that's BS. Well, for example, what if we come in at 37% growth, which is 1.8 million, so that changes what the earnings number is going to be, and that causes the number I just gave you to not be accurate. So clearly not an accurate number, but it's a sketch of what we see happening. So I'm, my take on things right now is that just as I predicted a $200 price, when you sketch out everything, because the real earnings number is above 4, it's in the 420 or 440 zone for the year, you actually end up with a stock price in the 220s, maybe even 230s at the end of the day. And what I believe occurs regularly is the large institutions have to validate their price, the price target that they're buying into, because they have to answer questions from investors of, well, why did you put the money to work in this way? And the answers are going to come back. We were validated by X number of firms that this is the growth rate, this is an appropriate price to pay for the stock, and therefore we can buy currently comfortably because we're trying to generate returns in a tough market. So I believe that, and I could be wrong, we're going to find out in 2 days, that there are a lot of large institutions that are optimized by buying Tesla right now before it goes on what could be a historic run, run from where we are now, 180 to, $300 to $500 a share over the next year or two is definitely in range. And with all the new products coming out and so forth, consumers are worried about the next 3 to 5 months. The big institutions are worried about the next 3 to 5 years. And in terms of having a huge product pipeline that results in nice growth for Tesla over that period, I just think we end up with a really sort of solid place to place money for the long term. We typically keep our show in a certain range, but I wanted to start off a discussion we may continue in our next show, which is there was a New York Times article that came out, and it looked at how large institutions were handling the zero or very low interest rate situation of a year ago. And what they concluded was that one of the reasons why Google, Amazon, all these folks were laying off is they took the opportunity to sort of grab cash that was available and dump it into things that didn't work out that great. So now they're getting rid of people related to, if you will, okay or bad acquisitions. One of many examples presented was in the case of Salesforce. They actually borrowed $8 billion to buy a company called Slack. Once they got the company, obviously they ran it after they purchased it, but of the 8,000 people they fired, most of them were former Slack employees. So the suggestion was that numerous companies, including Google, Amazon, Salesforce, and others, had picked up cheap cash and had gone out there and done things that sort of business-wise they were trying to grow, but they didn't really work out. So they still have the cash that they may have borrowed to do this, and things didn't work out. In the case of Tesla, they weren't out in the capital markets actually borrowing any of that money, and they're generating internal cash to grow as they're building new factories, etc. So you could argue that Tesla's sort of business fundamentals was different than most of the other tech firms. I was a little surprised when I read the article because in Silicon Valley, one of the rules of thumb is that you don't borrow money, even if it's really cheap. High margins allow you to sort of fund it on your own, and it doesn't create sort of a drag on the business of that debt going forward in case you actually need to use it for some reason. Happily with Tesla, all those new factories are getting put together off of internally generated cash, and it shows that Tesla is comfortable with cash on hand being used to fuel growth legitimately, whereas others are using other methods for their growth process. So in general, what I wanted to argue is that there's a disagreement among the analysts of where we are, where we're going, but it's my belief that Tesla is in a terrific spot right now with a lot of growth possibilities from new products primarily, but across the board, and a strong position relative to customers and its own supply chain. And therefore, we're going to see a nice sort of bump in what's going on. I think the biggest surprise for me and for everybody else is how rapidly Tesla has made the move. I think the short squeeze explains it, but also the fundamentals of what Elon presented support certain behavior by the institutions, and then everybody else is sort of dragged along by the thought process and implementation of these entities. And I think as we get into next week, we're really going to see movement of capital into Tesla because of its big cap brethren. I think it's the best option for solid money placement over the next couple of years. And that answer will come next week. So it might be an opportunity for you to load up and enjoy some nice returns. At any rate, I want to thank you for taking time to join us. We usually go to our health tips at this point. I had a psychiatrist who recommended a 20-minute walk every day as a way to address sort of health effects throughout your body, including brain function. And I want to say I'm trying it out, and it's awesome. Wanted to encourage you to consider it as well. At any rate, have a great day. This is Greg for Tesla Fan Insight. Just over Heathrow, Hoda Hafez Trasiche, Ni Hao Ma, Konbanwa, Japanese. In Jamaica, we say enough respect, walk good man. Thanks for joining us. Have a great day, and bye for now.